Welcome to The Explainer. Buckle up, because if you've been glancing at the charts lately, you already know we are staring down a massive, unusually high-stakes week for the US stock market. We're tracking some major, simultaneous shifts across three totally distinct sectors of the economy. And rather than just one neat little narrative, we've got multiple macroeconomic and corporate catalysts crashing together on the exact same timeline. It's a really dynamic situation, one that absolutely requires us to look way past the surface-level headlines and dig right into the structural crosscurrents that are driving institutional capital right now.
Okay, let's dive into this. What actually happens when three massive market-moving events rock Wall Street all at the exact same time? We aren't just tracking a single isolated earnings report here or some random economic data drop. We are looking at the ultimate convergence: big tech earnings, the Federal Reserve's policy decisions, and surging oil prices. Now, any single one of these catalysts has the fundamental weight to move the broader needle totally on its own. But all three converging simultaneously? That creates an incredibly complex web for institutional investors to navigate. So we really need to understand how these three pillars interact with each other.
All right, Pillar 1, big tech earnings and AI growth. You know the story. Over the last year, artificial intelligence has driven the lion's share of market returns. It's been huge. But seasoned investors are no longer satisfied with just the conceptual promise of AI, right? The market has heavily shifted its focus towards capital expenditures and actual profit margins. We are looking extremely closely to see if all this massive upfront investment in AI infrastructure is actually translating into real top-line revenue. The defining question for this quarter is simply this: are these historically high valuation multiples actually sustainable in the current environment?
And honestly, the stakes for the tech sector are entirely binary right now. On one side, you have AI-driven growth. If forward guidance and earnings beats show continued, tangible AI adoption, it could absolutely fuel another massive breakout rally for the Nasdaq. The momentum trade is still very much alive. But on the flip side, what about disappointing numbers? If that guidance misses the mark in any material way, we aren't just looking at a mild, healthy correction. Given how literally priced to perfection these mega-cap stocks are today, a slight miss could trigger incredibly sharp, immediate market swings. The margin for error has totally been priced out.
Which brings us to Pillar 2, the Federal Reserve meeting. While big tech gives us a great micro look at corporate health and innovation, the Fed dictates the absolute macro environment that those corporations have to operate inside of. Traders are literally on the edge of their seats right now, scrutinizing every single word of Chairman Powell's tone and waiting for any subtle revisions to the dot plot. The market is desperately looking for clues. Are rate cuts actually coming later this year? Or is this higher for longer narrative just the permanent new reality for capital costs?
The entire global financial system is incredibly sensitive to the specific meeting. Think of it as a rapid ripple effect across three main areas: 1, stocks; 2, bonds; and 3, the US dollar. Even a tiny hawkish shift in the Fed's outlook triggers an automated cascade. If the Fed signals hesitation on cuts, bond yields will predictably spike. That yield spike inherently strengthens the US dollar, which then acts as a heavy headwind, directly pressuring equities, especially those multinational tech companies we were just talking about, whose foreign revenues take a major hit. It's an instant, interconnected reaction.
But wait, there is a third, heavily impactful element turning up the heat on this whole pressure cooker: 100. That is the number every single market watcher is anchored to right now. Driven by tightened global supply from OPEC plus cuts and escalating geopolitical tensions, oil prices are rapidly climbing toward that $100 a barrel psychological barrier. Whether we are looking at Brent or WTI, this upward trajectory is not just an abstract ticker symbol flashing red and green. It carries immediate, heavy economic weight for every single sector of the market.
And here is exactly why that $100 mark matters structurally. It sets off a fast-paced chain reaction. Step 1, higher inflation. A sustained spike in energy costs threatens to completely reverse the recent macroeconomic progress we've made. Step 2, raised transport costs. That directly increases logistics and transportation overhead, which aggressively compresses corporate profit margins across the board. And Step 3, consumer and business pressure. When everyday consumers are forced to spend more at the pump, they spend less everywhere else, which ultimately stifles broader economic growth. It's a direct domino effect. And that brings us perfectly full circle. As the source material points out, this energy surge threatens to, quote, make the Fed's job even more difficult. Think about the structural collision happening here. The oil pillar is actively driving up cost-push inflation. That directly antagonizes the Fed pillar, potentially forcing the central bank to keep interest rates highly restrictive for much longer than Wall Street wanted, even if the broader economy is starting to cool down. The central bank is effectively boxed in by the energy markets. It's the ultimate economic collision.
So when you step back and look at the big picture, the convergence is striking. You have the aggressive growth engine of big tech, the restrictive monetary brakes of the Federal Reserve, and the inflationary tax of surging oil all colliding in the exact same week. We're staring at the perfect storm, higher market volatility. Because of this, traditional market correlations might actually begin to break down entirely. We are looking at deeply opposing forces pulling major asset classes in completely different directions, meaning widespread sudden market volatility is practically guaranteed as institutional capital aggressively repositions itself.
So looking at this rare alignment, I want to leave you with this to really think about. Which of these macroeconomic forces do you think is the true anchor of the current market? Can the sheer structural momentum of AI innovation outrun the heavy gravitational pull of a restricted Federal Reserve in $100 oil? I'd love to hear your take, so please weigh in on tech, the Fed, and oil down in the comments. And be sure to subscribe for more updates as this all plays out. Thanks for joining this explainer, and seriously, keep a very close eye on the charts this week.